Hello everyone, welcome back to the channel. In this video, we're going to cover a new stock that we have added to our portfolio yesterday. For this company, I'm going to talk about the business model, the financials, and the valuation. It takes a lot of time and effort to make these videos, so please consider liking this video and subscribing to the channel. Now, the stock that we just added is Trade Desk. It has ticker symbol of TTD. The stock is down about 33% in the past few days, and it is currently trading at $80. So we just initiated a position with 10 shares. Now, this is a small amount and a starter position. We would like to add more at $60 as the risk reward is very good at that price. Let me first discuss the business model and what does the company do. It provides a platform for ad buyers. Most buyers are ad agencies, brands, or other technology companies. The company offers self-service cloud-based platform that allows buyers to plan, manage, optimize, and measure data-driven digital advertising campaigns across various ad formats and channels, including video, display, audio, digital, out-of-home, native, and social on various devices, such as computers, mobile devices, TVs, and streaming devices. Now, let's look at a screenshot that shows hundreds of players that operate in this advertisement industry, right from the advertiser to the publisher. The company is in data management platform and DSP. Let's now look at some numbers. So at $80 a stock price, the market cap is about $40 billion. And for the past 12 months, the revenue was about $2.4 billion. This is a price to sales of 16, which is not cheap, but definitely not too expensive. The company used to be at a price of sales of over 20, and that is ridiculously expensive for their growth. TTD is profitable. They made about 400 million of net income in the past 12 months. The current PE ratio is 102, and the forward PE is about 44. The company has great margins. As you can see on the screen, the gross margins are above 80%, and I'm also showing the net profit margin and the free cash flow margin. As they achieve scalability and control operating expenses, they can easily get to almost 30% net profit margins. So in the most recent quarter, as you can see on the screen, they missed the revenue estimates. The expectation was $759 million, but they made $741 million. So for the past few quarters prior to that, they always met the revenue targets and beat the EPS targets. This revenue miss in the most recent quarter upset a lot of investors, and the stock fell significantly. There is one more reason why the stock fell to 33%. And that is the guidance that they provided. As you can see on the screen, they guided for a revenue of at least $575 million in Q1 of 2025, which represents 17% year-over-year growth. This company was growing at more than 20% in prior quarters. But when investors saw this less than 20% growth, they got upset and the stock sold off. So TDD is profitable. They made positive net income and free cash flow. The company used approximately $235 million of cash to repurchase its Class A common stock in the year end of 2024. They completed this purchase at an average price of $93, and they still have $464 million available at authorized for more repurchases. So since the stock is down to $80, the repurchase should be more effective now, and the company can buy back more shares compared to previous quarter. Now, let's look at the valuation as usual. It takes a lot of time and effort to make these videos, so please consider liking this video and subscribing to the channel. I will show you two cases, one with reasonable assumptions case and the other one with great execution. But please note, this is not financial advice. We're not qualified to give financial advice. This video is for entertainment purposes only. In the reasonable assumptions case, as you can see on the screen, they made $2.45 billion of revenue in 2024. I am estimating 20% growth rate year over year for the next 5 years for them to make about $6 billion of revenue. So you might be thinking, why am I assigning 20% when they only are guiding for 17% for Q1 of 2025? The reasoning for this is that they have a lot of opportunity in the TV and business of expansion outside of the United States. So based on the current gross margin of 80% in the long term, I am confident that they can make 27.5% net profit margin. So with this, they can make about $1.7 billion of net income by 2029. I am estimating a multiple of 35, with which they would be worth about $59 billion of market cap by 2029. Currently, they have close to 500 million outstanding shares. Since they are profitable, they are repurchasing the stock. So I'm estimating 1% buyback for the next 5 years, with which they will have 475 million outstanding shares. So when I divide $59 billion of market cap with 475 million outstanding shares, I get to a stock price of $123. So based on the current price of $80, this is a gain of 54% in 5 years. This is why I only purchased 10 shares. So for me to double my money in 5 years, the stock need to fall to 60 or below. The valuation will be more attractive at 60. And so I would be interested in adding a lot more shares at $60. Let me show you the great execution case. I am estimating 25% growth rate, with which they can make about $7.5 billion of revenue by 2029. With a net profit margin of 30%, they can make $2.2 billion of net income. With a multiple of 45, the market cap would be $101 billion. I am estimating the same 475 million shares by 2029. So with this, the stock price in 2029 would be $212. Based on the current price of 80, this is a gain of 165%. So I personally think that the company has a lot of opportunity to re-accelerate the revenue in the coming quarters, and that can spike the stock. But at the moment, I have started a position. I will continue to watch the upcoming quarters and potentially add to my position. Let me know your thoughts in the comments, and thank you so much for watching.